Good morning, Roy. With the recent market rally, have you made any changes to your client's portfolio?
I review my clients' portfolios regularly, but not too frequently. So the rally that you're referring to, in effect, started in 2009 after the global financial crisis. My clients have medium to long-term financial goals, and their investment objectives are tied to each of the specific goals. And so the normal portfolio rebalancing occurs twice a year, and it's not a reaction to whether the markets are going up or down. So for my clients, the next rebalancing will be done in a few weeks for this year.
What do you think are some of the macroeconomic indicators that may influence portfolio asset allocation?
So asset allocation is something that is very personal to an individual investor, and it is not a reaction to future economic indicators. So after the required long-term rate of returns is estimated, so that's a fixed percentage for each client, then the strategic asset allocation is set. So what is asset allocation? It is the split between equities and fixed income and cash. And then this will be judged according to the risk profile of the investors. And so if macroeconomic indicators such as interest rates or unemployment, whether they go up or down, it really should not have a direct bearing on the asset allocation of the clients. But tactical asset allocation is a different thing, and that will be done on an individual basis. But the most important question is to answer is you cannot time the market in response to macroeconomic conditions.
Investors look for the right time to buy, but how hard is it to pick the right time to sell?
So for long-term investors, any time is a good time to buy. It's just like buying a home. You need it for the long term. Any time is a good time. But the decision to sell the assets is either planned or unplanned. So a planned decision to sell could be because the financial plan dictates you have to send your children to study, or you want to upgrade your home, or you are ready to retire, and therefore you need to sell assets in order to turn it into cash. Rebalancing, by the way, is also involves selling, because you have to sell before you buy. That's all normal transactions. However, for clients who do not plan to have sufficient contingency cash in the bank, then they will be forced to sell assets, and the timing may not be right. But I'm definitely not a proponent of timing the market. In other words, sell the assets in anticipation of a market correction, and then or take profit. These are concepts which I don't apply to my clients.
So lastly, what do you think are some of the commonly held misconceptions about investments?
I can think of a few. So for example, the definition of investment versus speculation, that must be clear in your mind. Speculation is trying to make a quick buck. In the course of the work that I do with my clients, I try and make sure that those who want to take a punt on a particular stock, or maybe in the property market, those kinds of actions are kept separate from their long-term, non-negotiable investments. So that's the first thing. Secondly, frequent transactions is not a good thing, because there are costs associated with the transactions. So we need to manage for real serious investors to try and buy, hold and monitor and minimize the number of transactions. The media has a big impact on individual investors. So if you are a true investor, you are not going to respond to what the media says, or what we call the herd mentality, peer pressure, for example. You need to have your own goals, and then you decide how you're going to be investing. And then finally, all I can say that patience is a virtue. There is no free lunch, all right? You're not going to make a quick buck. So for your medium to long-term investments, you have to be patient before you get your results.